Emerging economies are now growing at a pace that stands out in recent history, with many countries posting higher growth rates than advanced economies and narrowing some of the most persistent gaps in income and industrial capacity. This acceleration is visible in a range of indicators, from GDP growth to human capital development and export diversification. While the precise numbers and timelines vary, the general trend is clear. The economic distance between what were once labeled developed and developing nations is shrinking faster than conventional growth models anticipated. Several factors drive this faster convergence. Demographic trends in many emerging economies, including larger working-age populations and expanding urban centers, create a foundation for sustained growth. Investment in education and skills training, often supported by targeted government policy, has enabled more people to participate in higher-value industries. Improvements in infrastructure, such as expanded access to electricity, transportation networks, and digital connectivity, have reduced barriers to productivity and allowed businesses to scale more quickly. Technological adoption plays a critical role. Mobile banking and digital ID systems, for example, have expanded financial inclusion in places where traditional banking infrastructure remains limited. These tools help governments deliver benefits more efficiently and support the growth of small and medium-sized enterprises. In manufacturing, automation and robotics are increasingly accessible beyond high-income countries, allowing firms to compete in global value chains and move into more sophisticated production. As a result, exports from emerging economies now include a greater share of electronics, machinery, and high-tech goods, rather than relying solely on raw materials or low-value assembly. Trade relationships have also evolved. Emerging economies are more integrated into global supply chains, both as producers and consumers. They have diversified export profiles, moving beyond commodities to include processed foods, chemicals, and advanced components. This diversification makes economies more resilient to external shocks and creates new opportunities for growth. At the same time, regional trade agreements and new financial arrangements, such as local currency settlements, reduce dependence on traditional hubs and major reserve currencies. Financial markets reflect these changes. There is a growing appetite for local currency bonds and infrastructure financing within emerging markets, and international investors are increasingly willing to hold assets denominated in a wider range of currencies. Improvements in monetary and fiscal management have contributed to greater macroeconomic stability, although challenges remain, particularly in countries facing external debt pressures or volatile capital flows. Institutional reforms have supported economic development by streamlining business regulation, strengthening legal systems, and improving public administration. These changes help attract investment, foster entrepreneurship, and promote more efficient allocation of resources. While progress is uneven and some countries continue to struggle with governance challenges, the overall trajectory points toward stronger, more capable states. Despite these advances, convergence is not uniform. Some countries continue to face significant obstacles, including political instability, high debt burdens, and exposure to climate risks. Regional disparities persist, and not all segments of the population benefit equally from growth. However, the broad pattern of faster convergence challenges older assumptions about static global hierarchies and highlights the increasing diversity of development pathways. This changing landscape has important implications for the structure of the global economy. As emerging economies gain weight, traditional categories and models become less effective at explaining outcomes or guiding policy. The rise of new economic centers, shifting trade patterns, and evolving governance structures suggest that future economic systems will look different from those of the past. Understanding these dynamics is crucial as we consider what comes next. The evolution of economic systems will not follow a single path, but will instead reflect a mix of inherited practices, local innovations, and responses to new challenges. This sets the stage for examining how economies might adapt in the years ahead, blending elements from multiple models to address emerging needs and opportunities. The future of economic systems. Looking at the range of economic experiments underway in 2025, it's clear that no single system offers a universal solution. Instead, countries are drawing on a mix of ideas, sometimes blending market incentives with public investment, sometimes layering new technologies onto older frameworks, and often adapting policies to fit their unique social and institutional contexts. The evidence so far points to hybrid models as the most promising path forward, but each approach brings its own set of trade-offs and uncertainties. Recent policy trials highlight that adaptability matters more than strict adherence to any ideology. Some governments have expanded public roles in housing or healthcare, while others have focused on deregulation and private sector innovation. In practice, the most successful outcomes tend to come from systems that are able to adjust to changing circumstances, whether that means responding to technological advances, shifting demographics, or new environmental pressures. For example, countries with flexible labor markets and robust safety nets have managed workforce transitions more smoothly as automation displaces certain jobs. Meanwhile, those investing in education and retraining see better results in preparing workers for emerging industries. Technological change is accelerating these shifts. Artificial intelligence and digital tools are being used to improve everything from tax collection to public transit planning. While these technologies can increase efficiency and help target resources, they also raise new questions about privacy, equity, and the limits of algorithmic decision-making. Most governments are still figuring out how to strike a balance, using technology to support decision-makers without relying on it as a replacement for human judgment. Efforts to measure economic performance are also evolving. Standard metrics like GDP are increasingly seen as inadequate for capturing well-being or sustainability. Some countries have begun to use dashboards that include indicators for health, education, environmental quality, and social cohesion. These alternative measures do not replace traditional economic statistics, but they offer a broader view of progress and highlight areas that need attention. The challenge is to integrate these new metrics into policy in a way that leads to real improvements, rather than simply adding complexity. Environmental concerns now play a larger role in economic planning. As climate risks become more apparent, many countries are introducing policies that account for environmental impacts alongside financial outcomes. This includes new regulations, carbon pricing, and requirements for companies to disclose their exposure to climate-related risks. These changes are not uniform, and progress varies by country and industry, but the trend is toward greater integration of environmental factors in economic decision-making. Financial systems are also adapting, with central banks testing digital currencies and new forms of regulation. While digital money offers new tools for managing monetary policy and inclusion, it also brings risks related to security, privacy, and the stability of banking systems. Most experiments so far suggest that these technologies will supplement rather than replace existing financial structures, at least in the near term. Cultural factors remain important. Economic systems that work well in one country may not translate directly to another, given differences in social norms, legal traditions, and public expectations. The experience of the past decade shows that attempts to transplant models wholesale often run into resistance or unintended consequences. Instead, the most effective reforms tend to build on local strengths, gradually incorporating new ideas and adapting them as needed. Ultimately, the future of economic systems seems to rest on continuous experimentation and incremental change rather than sweeping transformations. The willingness to learn from both successes and failures, to adjust policies in response to new evidence, and to balance competing priorities is what allows economies to remain resilient. This process of trial and adjustment is not new, but in a world facing rapid technological and environmental shifts, it has become more important than ever. With these realities in mind, the search for better systems remains an ongoing effort. Each experiment, whether in policy, technology, or measurement, offers lessons that shape what comes next. As we reach the end of this analysis, the record from 2025 is clear. Focused economic experiments across a range of models have produced valuable lessons, but no single approach has solved every challenge. Countries testing alternatives, from new ways of measuring progress to targeted labor and housing reforms, have demonstrated both strengths and shortcomings. These pilot programs, whether in happiness-based metrics or public housing, show that adaptation and context matter as much as the model itself. Continued experimentation remains essential. The most promising results come not from wholesale adoption of any one system, but from incremental adjustments based on evidence from real-world trials. This ongoing process of testing, learning, and refining is what drives meaningful economic progress.